This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
It is my pleasure to welcome a returning guest back to the show, and that is Kevin Bupp. He is the author of Cash Flow Investor, and he likes to invest in mobile home parks and parking lots. Kevin, welcome. How are you?
Hey, Jason. Good seeing you, buddy. Always great to be back here.
Good to see you. It's been a while, so it's good to have you back.
You're looking good, man. You're looking good, so I love it.
Likewise. First of all, before we dive into your two favorite asset classes, I want to talk about the economy in general. You know, there's so much going on in the world. It seems like it's just a crazy and amazing time to be alive. We've got an administration that is disrupting literally everything under the sun, I think in a good way. I'm quite excited and happy about that. And, feel free to disagree with me, but, what is your take on the economy, interest rates, inflation, just all of the different things that are going on, tariffs, whatever you want?
Yeah, no, that's a great question. I mean, just speaking to the administration, I agree. I think we needed a disruption for many administrations now, and it's hard to say. We've all got our opinions. I don't know how this turns out a couple years from now. I mean, I think that we're going the right trajectory. I think it's all positive changes that are taking place. There was just a lot to clean up, right? I mean, it's a freaking mess that he got thrown into. So you got to give it some time, got to let it breathe. And I don't know if the changes that are taking place right now are good or bad. I think we're going to have to look back in the rearview mirror in a couple of years and make that determination. But I think my gut tells me that there's more good happening now than bad, and much more good than what has historically taken place over the last couple of administrations, minus Trump's first go around. So as it relates to, I can speak to real estate of kind of what we're seeing out there in the marketplace. As you had mentioned, we're in two different sectors. I mean, we focus and stay in our lane. We're in two verticals. One is mobile home parks. We've been buying parks now since 2011, so over a decade, and still love the asset class as much as we did back when we bought the first one. And then parking is one of the newer ones. We've been buying parking for about 6 years now, and really love the asset class for many reasons. Some very different than that of why we love mobile home parks. But I mean, speaking as far as like what we're seeing in the marketplace, I always like to say that like the fundamentals, we talked about this before we start recording, like the fundamentals of buying real estate really haven't changed. While the capital markets have changed, interest rates have grown at historically high rates over the last couple of years and are, continue to remain there. But buying deals that make sense, paying the right price for them, buying deals that cash, that have a clear pathway forward to make a profit, like that really hasn't changed. And so while rates have gone up, it's become a little more difficult for us to raise capital. We've been doing quite well. We've had a great last couple of years. We've been continually able to raise capital from our investors. We've continued with distributions, 34 consecutive quarters of on-time distributions now since we've launched our first fund back in 2014. And so,
Kevin, do you feel that investors are pretty flush with cash right now and wanting to deploy it?
I don't know if flush is the term I would use. I mean, I think there's capital out there. I think there's a lot of reluctancy from a lot of LPs. Like we raise capital from your traditional retail investor, high net worth individual. And as you know, there's a lot of folks that have lost money with different syndicators where deals have gone south, and either some or all of their investment basically vanished.
And is that in the multifamily world you're referring to?
I think for the most part.
Yeah.
I think for the most part. Yeah. I mean, at least, again, I even have some of my own personal LP investments that have either, partially vanished or completely vanished. And all of mine are 100% related to that of multifamily investments. But I think so. I think again, in the standard retail world, I think that's created some reason for concern, even if folks still have capital to invest, they're reluctant to do so. They had such a run up and such a comfortability of, anything, the rising tide lifts all boats, right? And so anything they invested in, prior to the interest rates going up for a good 10-year span, even if it was a horrible operator, it just seemed to work out, right? It
Yeah.
made money, and a lot of times it made 2 or 3x of what the original projections were. So I think there's capital out there, looking for the right home. I think education is more important now than ever. Just getting investors not just comfort with from a 10,000 foot perspective, but really understanding the niche that you're in, who you are, what you do, and what do you do differently than that of maybe some of the other investments they've been in. Communications incredibly important as well. And I'd say that a lot of our new investors that are coming and that haven't worked with us in the past, I would say they're diving quite a bit deeper. So general LPs, like they're looking to invest their capital, they're diving quite a bit deeper than they have ever before, which is great, right? Like they're actually having conversations with current investors. They're doing their due diligence, which
Right. They're
again,
they're more concerned about getting ripped off
absolutely.
or just getting in with someone who's inexperienced. As I
That's
always
right.
talk about, when you invest in someone else's deal, you leave yourself susceptible to three major problems. Number one, you might be investing with a crook. Number two, you might be investing with an idiot. And either way, you're going to lose money, right? But number three is, they take a giant management fee off the top for managing the deal, right?
Mhm.
And so even if there's good profit there and it's good asset, you're getting the crumbs sometimes, right? And so,
Yeah, and
we'll
yeah.
we'll talk about that. But in the apartment world, I just want to caution people, because you see this happen in multifamily, and so many people got burned, and they're still getting burned because they're still in these deals and they still suck, and it's just tragic what's happened. And I think we got to go back to the old idea that everybody's a genius in a bull market. And some of these apartment syndicators, they had like no experience. I mean, they
Mhm.
just basically took people's money, and everything was going up. They thought they could retenant these buildings, raise the rent by 1/3, and just refinance. And they just couldn't do it when the rates went up. They just didn't have safe performers on
Yeah.
realistic market conditions. They had very unusual market conditions of the lowest interest rates literally in 5,000 years. And I'm not kidding when I say that.
Mhm.
Okay. There's a great book, by the way, by David Graeber, the late David Graeber, called Debt, the First 5,000 Years. So those interest rates were completely abnormal. And they were doing
Mhm.
performance based on these abnormal low rates. You want to speak to that at all?
Yeah, no. What I was going to say is, I think the other element there, kind of ties in with inexperiences. The deal started getting so skinny that the only way to ever achieve, the projected IRRs or whatever metric they were using
Yeah.
that they were putting out there was not necessarily to even refinance. It was to be able to sell, and both become challenging when rates
Mm-hmm.
go from 3% to 6%, right, in
Yep.
a short period of time. And so I think a lot of them found themselves like they never really had the plan B. The plan A was to actually just exit out of it and
Mm-hmm.
achieve their returns. And ultimately, that plan A with no plan B in the backup, like neither one came to fruition because rates went up and now they were essentially stuck. There was no other option there. And so I think it was just short-sightedness, and capital was free flowing. I think that became the biggest challenge, and a lot of that ties to the inexperience of investors. Like they had never been through a cycle.
Yeah.
Investors are looking to hand over cash to them. They know that if they turn that cash away, they don't deploy it into an investment, that cash is going to go find another home, right?
Mm-hmm.
And so, again, making short-sighted decisions to take the capital, I'm going to put it to work no matter what, and ultimately, hope and pray on a star, and hopefully ultimately that prayer didn't play out.
Yeah.
So,
Yeah.
it's an unfortunate situation, and a lot of folks have lost money, but
It
again, I
hurts the
think
whole
just
industry. It really does. Yeah.
yeah, but.
Yeah. Okay. So your take on the economy, inflation, where are we going? Real estate prices, where are we going? Your asset is sort of, what some people call the last stop before homelessness, right? Because it's inexpensive to rent a mobile home. And I have a mobile home park. So, I understand that. Although mine's more for vacationers, a little bit, it's like weekend homes for a lot of them. It's not all
Yeah.
permanent type residents.
Yeah.
Speak to the housing shortage and all of that.
Yeah, one of the interesting things that's played out that we've watched play out over the last couple of years with inflation and prices going up at all-time record speeds is that what historically used to be, and you reference that, like our type of housing product is really kind of the last resort, but it's not necessarily the lowest quality. And so there's different qualities of mobile home parks. There's some that are on the wrong side of the tracks. There's some kind of right
Yeah.
down the fairway, blue collar, folks that are working, want to
Yeah.
send their kids to, to the good public schools. And you've even got some that are more lifestyle design, right?
Yeah.
Like you live in Arizona and here in Florida. There's some that I would definitely take out of the affordable bucket, right? That folks are living there because they want a lifestyle choice and want to be around other seniors that are into active lifestyle. So, but with that being said, what we have seen is that a lot of even a lot of would be like first time home buyers, folks that like younger families that wouldn't have traditionally, been applying or looking to move into our communities are probably the highest percentage of applications now. Folks that might have historically gone to buy that starter home at $250,000, $200,000. Now that starter home is $300,000. They're priced out of the marketplace, and so I'd say about 45% of our applications over the past 2 years have been folks under the age of 30, which is historically, it's
In other
completely
words,
the opposite.
mostly people that live in mobile homes are older. That's what you mean, right?
Yeah, older, or they've got older kids, or they've downsized, and it's just a husband and a wife, or they're even retired, they're seniors. But yes, historically that would have been the case, and now it seems to be flip flopping. And I think number one, a big piece of that is the affordability component, right? The average individual that was used to be looking for that $150,000 starter home, now it's truly priced out of the market. They can't afford it, and so their option at that point in time was like, okay, we have this dream to own a home. Well, the standard way of how that was always looked at is it's not now a possibility for them. And so they have two options. They either go rent an apartment that's got neighbors above, below, side to side, still, paying $1,500, $1,600, sometimes $2,000 a month, or they go buy a mobile home. Like there's no other option. If they want to be a homeowner, they can go buy a mobile home in a mobile home community. And typically they're going to find that their actual overall all-in price, their, the lot rent plus the actual home payment portion is, at least in our communities, if you compare kind of what we offer to that of the local market when looking at apartments, we're normally about 15 to 20% less in overall total cost on a monthly basis. So now they have the opportunity to actually buy a home. They can have literally their own little yard, their own parking spaces, sometimes even a garage attached to it, and still be in that overall affordable payment realm. Whereas buying that stick built home just isn't a possibility for them at this point. Maybe the mobile home becomes a stepping stone until they can make more money at their job, create more income, and ultimately be able to buy that standard single family home. But so it's interesting watching that change and watch that play out. And I think another piece of that of why that's happened, and the mobile home park world, you referenced that you own a mobile home park. The quality of these homes is so very different today than what it was 10 or 15.
It's
or
much
20
better.
years
Yeah,
ago.
no question.
Oh, it's a night and day difference. I mean, it's a lot of the same materials that are used to build your stick built homes are built in these mobile homes, and the quality of finishes is all the same as well. So they're really getting a good quality product for a very affordable price.
So, Kevin, you've been buying parking lots for 6 years. Why are you so excited about parking lots? Is it the opportunity to source them? Have the deals gotten better? What's going on in that market?
One factor that really piqued our interest many years back is I came across a report, an article, white paper that was written about there's a shrinking supply of parking in lots of the major cities across the country. But more granular than that is that a lot of the major cities across the U.S. have, in the last decade, have completely removed the parking minimum requirements from new developments. Whereas historically, if a developer wanted to go in and build a tower, a high rise, whether it be a hotel, an office, mixed use building, they're always required to build a certain amount of parking stalls for 1,000 square foot.
Yeah, usually four spaces per thousand is the typical.
Yeah, and most of the time, developers were required to build a surplus, way more than they would ever actually make use of. And a lot of cities required that they had a surplus of parking over the years. So a lot of cities have started working towards limiting these parking minimum requirements. And so that was one piece of it, is that you've got the shrinking supply. But the second piece for us that I think was really compelling is being able to buy what we deem to be irreplaceable real estate. Using the example, I think I referenced that we bought a property in downtown Phoenix. This property it's on its own parcel ID, so it's not attached or underneath an office building. So we've got air rights there as well. But it's a 3-acre parcel of land right in downtown, immediately adjacent to the courthouse, or right around the corner from a multitude of restaurants, bars, hotels, sports arenas. And so it's got a variety of demand drivers. And so we look at it as it's a cash flow and covered land play that makes a great deal of economic sense today. We can make the numbers work today, and very strong numbers at that. Buy it at a really attractive spread, going in cap rate to that of where the debt's at. And it's again, it sits on a piece of dirt that I know that when we don't underwrite this piece, if we kind of look at it as icing on the cake, to where we know that inevitably, whether it be 10 years, 15 years, 20 years, there might be a point in time where there becomes a higher and better use of that piece of property. But at that point in time, yeah, we can redevelop it into something else. But until then, we've got a cash flow covered land play and a prime location in some of the largest cities within the country.
What's the cap rate?
Yeah, so the one I just gave you the example of, we bought in, it was like a 7.6 cap going in. At that point in time, our debt on that one was 6.1, and then we've added quite a bit. Our stabilized cap today on that one is about an 8.9, so quite a bit of spread there. And we just recently bought one in historic Philadelphia, about a 200-point basis spread going in on it, and it's a core asset in a again, irreplaceable location where very difficult to ever build another standalone garage. In fact, a lot of these cities actually have moratoriums. It'd be very difficult, even if you had the land, to build a standalone parking garage.
Kevin, one of the interesting things I've thought a lot about, and I don't know where to go with this idea, but I read that about 40% of the typical American city is covered in parking, is used for parking, about 40% of the land.
That's right.
And when we really see self-driving cars and cars as a service, right, where people don't own as many cars and they just summon a car because they'll be, ideally so prevalent that you just won't need a car. I mean, a lot of people don't have one now. They just use rideshare services, or ride hailing services. What do you think about that in the future of parking? Yeah. Is it really a play, because that parking may become a lot less necessary, but then you have the alternate use that you alluded to of that property. Is that the ultimate play, or what do you think?
Yeah, no, and I think that there's real concerns around autonomous vehicles, the self-driving cars, and what that looks like 5-10 years from now. I think that's evolving incredibly fast. I'm not one of the naysayers that says, "Hey, Jason, that's crazy." Like, to think that cars are going to drive themselves and we're not going to own a car in the next 10, 15, 20 years. I think there's reality there, and I think some cities are going to adopt that,
and probably faster than that. I mean, here in Phoenix,
right.
Waymo. I mean, these self-driving cars are everywhere, and you just jump in. There's no driver. It's great. You can listen to whatever music you want. You don't have to talk to anybody.
Yeah. No, a couple of, like, using the Phoenix example. So there's a litany of factors there. And again, we look at what are the overall demand drivers. So about 40% of our demand drivers there are from the courthouse traffic across the street. So not saying that autonomous vehicles won't have an impact there, and those that need to show up on their court date, will take one of the hail riding services versus that of driving their own car. I think there would be a proportionate share there, but to think that everyone will stop driving their vehicle,
of course not. Yeah,
it won't happen.
Right.
And then the same thing goes with the sporting events. So another about 30% of the revenue makeup there is the Footprint Center, and then where the Phoenix Suns play. And so again, a lot of these folks are driving in from sometimes 45 minutes, an hour, maybe even further, that from the suburbs coming in. And so again, I think a
pretty expensive ride share.
That's right. So a litany of factors. But then lastly, I think as long as you've got the right location, there will always be a need to stage these vehicles as well. I mean, maybe not 100% of them. Maybe they'll figure out the pattern to where these things can just keep circling around. But there will inevitably be, a time where they'll have to park somewhere. They'll have to stop somewhere at some point or another. Maybe it's to recharge overnight. Maybe it's in between stops. And so again, I think location is the most important. So I think as long as you have one of the most prime pieces of real estate, there will always be a need, whether it's a current use today or another use, there will always be a need. So that's kind of how we look at it. I'm not going to try to change the future, the trajectory of where it's heading. Right. So as long as we feel comfortable with the location, that inevitably there will be another higher and better use at some point in time. We're comfortable with that.
Yeah. Okay, good. So, hey, let's talk a little bit about your funds and maybe, the way they're structured and what might be compelling to investors. We talked earlier about, like, management fees and things like that. How do you structure these funds, and what do you charge for your work in sourcing deals, managing deals, and what does the fund investor get?
Yeah, no, absolutely. So ours is pretty straightforward. We've got 3 different classes. It's either an 8, 9, or 10 pref, and all that's driven by the amount of capital invested. So it's on a tiered system. 100,000 at 249 is an 8 pref, 250 at 499 is a 9 pref, and then above
so let's just talk.
Pref.
Yeah, great. Okay, so let's just talk about, if someone invests $100,000 with you, they get what, an 8 preferred return of 8%?
That's correct.
Okay, and then what about the upside? How does that work?
Yeah, then it's a 70-30 split, whereas the waterfall, they get 100% of their invested capital back before we participate in any of the promote. So myself and my partner, basically we don't get involved at all in the promote until after 100% of the capital is returned, either via a sale or a cash out refinance.
Right. And so what that means is the promote is the share of the profits you get on the liquidity event, right?
That's correct.
Okay, great. Do you want to compare that to any other funds?
I mean, I think it's a pretty standard model. I mean, it's a traditional US waterfall. And I think it's very similar to that of even a lot of standalone syndications. It's probably the most common structure that I've seen in the retail world. Institutions start getting fairly convoluted with catch-up provisions and tiered waterfall structures, but it's pretty straightforward and simple. I don't know if I have another one exactly to compare it to of
Sure.
that's out there in the retail marketplace without naming names or maybe misrepresenting them and saying why ours is different. We have a third party management fee, so we actually are vertically integrated with property management. It's kind of I don't know how you handle your mobile home park, but we've gone through the motions years past of outsourcing management to a third party management company and
Right.
had a horrific experience. And so
Yeah. So you have your own management company.
that's correct.
Yeah.
That's
And
correct.
so basically the fund pays your management company to manage the deals, right?
That's
And
correct.
yeah. And I assume you're charging your investors like industry standard rates
That's right.
on the management, right? Okay.
Yeah, I mean, the
So
management company is kind of the necessary evil. I always joke and say that
yeah,
it's not a profitable endeavor. If it breaks even, we're happy. But really, we get to control from A to Z and actually be fully accountable for everything that happens inside these communities. Whereas outsourcing it to a third party management company, you lose a lot of control. No one's ever have a direct alignment of interest with your investments. And so we moved away from that model about 7 years ago and built out our own infrastructure.
yeah, I agree. That is the problem with property management is you have an natural inherent conflict of interest. A property manager cannot serve two masters, right? They can't keep the
That's right.
tenants happy and the owner happy necessarily at the same time and themselves happy. That's the
That's
other
right.
problem. Yeah,
Absolutely.
yeah, good point. So you do a fund structure. Have you ever been a syndicator or always doing funds?
Years ago, Jason, we used to do standalone deals. We just found that a lot of the push for us to do a fund versus an individual deal, really, the catalyst of that was back in 2014. I mean, it was that year that we started our first fund. We had a pretty robust pipeline, and back then, mobile home parks, the average transactional price was significantly less than what it is today. Like that the business evolved quite a bit, and price per lots back then were you could buy things for $20,000 a lot, whereas today that same park might be 50, 60, $70,000
I
a lot.
remember
So
when they were considered $7,000 a lot.
right, or that, right, or maybe even less. And so there was a period where we had like 6 deals in the pipeline, and they were all 700,000 to maybe the highest one was maybe $2 million. And we started
Mhm.
looking at the legal fees associated and the documentation prep fees associated with each one of those individually, and then the logistics of actually closing all those out. And we're like, wouldn't it be so much simpler if we just put all these together? They were in good complementary markets. They were close to one another, but offered enough variety that gave investors diversity in different markets. And so we just pitched it as let's see what happens. Let's see if there's takers. We could lump all these, instead of $6,000 or $7,000 of legal fees for each one to get the PPM and all that outlined. How about we just make a one fell swoop? And that's what we did. Like literally, that became our first fund on those six assets that we purchased, and it was well received, and investors were happy. They liked the diversity behind it. We're like, hey, now it's time to launch another fund. Let's try that again, right? On a more robust scale, not just because we've got 6 deals in the pipeline, but we had great deal flow, and we found that it was just logistically and economically more beneficial for us and the investors to do it in that manner than that of one by one by one. So
Right.
that was really the original catalyst of it, and we've just again don't fix what isn't broken. So we've just kept with that same business plan
Right.
for the last 10
And
years.
Kevin, why have multiple funds? I mean, is it just completely impossible, or I guess it doesn't make sense to just have one fund and then just keep adding assets and selling assets within that fund and offer return to investors? Is that just impossible mathematically? To
Yeah, I mean, there's some complexities when you start getting into the evergreen funds. You have to have redemption language in there, and it's definitely doable. There's lots of evergreen funds out there, but
yeah,
and we've considered going that route. I think probably the long-term vision will be to actually create an evergreen fund at some point now, because we've got a number of investors. They don't want to have a tax event every time we sell something, right? That offers other challenges for them. And so we've got a number of folks that, given the opportunity, they would just simply roll out of a historic fund. If we were starting to dispose of it, they would actually just roll their proportionate share into an evergreen fund. And while the others, maybe there's a portion of them that just want to get cashed out and move on. And so it's really hard to offer everybody everything that they want. And
of course.
For this period of time, we felt that to keep things simple, we've just kept doing what we've been doing. And but the evergreen conversation is real, and it's just hard to please everybody all the time.
Yeah, get it. Okay, good. Anything else you want to share as we wrap it up?
Again, I think you make comments on this quite often. Like it's always the right time to buy real estate. I mean, there's opportunities out there today. There's opportunities out there yesterday. There'll be opportunities out there tomorrow. Just get out there and get active and make offers. So that's it. I mean, it's an exciting time.
Yeah, I couldn't agree more. Give out your website.
KevinBupp.com is my personal website. SunriseCapitalInvestors.com is our company website. And you can also download my podcast on either one of those websites. You can, on our company page, you can see our current offering, historical offerings, different case studies, and things like that. So lots of good resources there.
Kevin, thanks for joining us.
Thanks, Jason. Appreciate it.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.